Well, good morning, everyone. I'm Emily Drake, an advisor with Fairport and Luma Wealth. We hope you had a lovely holiday weekend and that you and your families are healthy and happy. I want to welcome you to our 7th virtual investment town hall. It's hard to believe we're already a third of the way through 2022, though with the recent snow showers, it hardly feels like spring. Our Chief Investment Officer, John Silvis, and the investment team have prepared a presentation which includes a review of the last quarter, some relevant economic data points, our outlook for the market, and some comments on our portfolios. As before, we've asked for your questions in advance, and we've attempted to incorporate those answers in today's presentation. Everyone is muted on this call, and as much as we'd like to see your faces, they become a distraction, so your cameras are disabled. We've incorporated some polls into the slides to hear from you, to keep you on your toes, and to keep it interactive. Should additional questions arise during the presentation, you can type them into the questions section of your toolbar. We'll answer as many as we can, time permitting. With that, it's my pleasure to turn this over to John Silvis, Fairport's Chief Investment Officer.
Thanks, Emily, and thanks everybody for joining us. It's hard to believe this is our 7th one. I didn't realize that till you said it. So I guess time flies when you're having fun, as they say, right? So I'm gonna kick this off. As Emily said, if anybody has any questions, please feel free to include them. So I like to start off with something a little lighter, but if there's one question we get a lot about, and we got a couple prior to this, is inflation. Where are we going with it? How does it affect everything? How does it affect the economy, portfolios, the markets, and those things? So I thought these were apropos to include. As you can see up on the upper left there, for whatever reason, people are most concerned about the prices of gas. So that is a big thing, and how much that's going to affect the consumer spending going forward. But it's kind of one of those things, either you laugh or cry. I think I saw gas today was on $3.70, so I think it's coming down a little bit, and we'll talk a little bit about that as well. A couple of points in there, but inflation is high. It is something a lot of people talk about, and we'll get to. I think, if I'm not mistaken, the March CPI numbers, which we got a few weeks ago, came in at 8.4%, which was a high since 1981. So it's a reason why everybody's talking about it. The next slide. So kind of the first quarter in review. Emily and I and some of the other advisors have been doing a lot of calls, and a lot of it, focus around a couple of things. So I'm going to kind of lay it out ahead of time, and then we'll touch on them as we go through the presentation. But a lot of the reasons, the questions we get is why the decline in the equity markets, why the increased volatility, what's driving that? Is that longer term? Is that a shorter term issue? And I tend to put it in three things, technically four, and I'll go through each one of these during the presentation. But one is, we're seeing a shift in Fed policy, which is something we haven't really seen in a long time. We've seen some periods where the Fed has raised rates, but it's been fairly benign. So if you go back to that, the financial crisis of 2008, 2009, really since then we've had a pretty easy Fed policy. Rates have come down fairly steady over, since 1980. And, we're seeing a shift in policy. So it's a big deal. How does that affect the markets? How do the markets interpret that? So that's one thing. I think, inflation, as I mentioned a few seconds ago, was considered transitory at one point by the Federal Reserve. Now it's more of a structural issue. How are they going to approach that? How long will it last? Where do we go? Is there a new normal in inflation? So again, we'll touch on that one. The third one, I think, does grab the headlines the most, is just the geopolitical issues, mostly the war in Ukraine with Russia. How does it affect the oil markets? How does it affect the equity markets? And then I guess to a secondary thing is, there's China lurking in the background, and does that affect how they approach Taiwan, which they view as a part of China, and what's the long term there? And I think the last one, if I threw out there, and it's probably a second half story, is just the midterm elections. We are in a midterm election year. Those do tend to be a little more volatile. We'll talk about that as well. So those are kind of some of the themes and why we've seen some of the increased volatility, and we'll touch on each one of those as we go through the presentation. So just first quarter in review, both bonds and stocks started the year off with negative returns. As you can see, that third column from the right, commodities kicked off the first quarter rising 25%, building off last year's returns as well. But as you can see, as you go further down that column, large cap equities right about the middle, that green color is we're down about 4.6%, and fixed income coming in near the bottom there at almost 6% decline on bonds, and that's piggybacking off last year's decline of 1.5%. Just to kind of give you a little update, so far the S&P is down a little bit quarter to date. It's down about 6%, not counting this morning. The ag or the bonds are actually down further, down almost 9% at 8.8%, something we're keeping a close eye on. And then the All Country Road Index, or the ACWI, which is a global index, which is something we keep a close eye on and we actually benchmark against, was down 5.3% so far. Those are as of yesterday. It does seem increasingly likely we're to see 2 years of negative returns in bonds, which is pretty rare. It doesn't happen very often, but if rates stay where they're at or close to where they're at, that's likely going to be an issue as we get into the end of the year. So as I mentioned, volatility has remained high for most of the first quarter. One of the themes we talked about at the beginning of the year, we mentioned that we thought volatility would be higher than most times, and so far that's played out pretty well. You can see my cursor on the far right side. We had a decline of about 13%. If you actually go from the high, intraday high to intraday low, it's almost 14.5%. So that's pretty typical of a midterm year, and I'll point that out. And we finished the quarter down 5%. So off to a slow start, to say the least, in the first quarter, but we think there's some signs that maybe the worst is behind us, and I'll talk about that in a few seconds. As I mentioned, pullbacks are to be expected. Again, we pointed that out earlier in the year. We thought we'd see a correction of 10% or more. We actually saw one about 14.6 again from peak to trough, 13% give or take from end of day to end of day. Not really important, but we have seen some volatility. And as you can see on this slide, the S&P corrections, during a midterm year tend to be, which is year 2, tend to be about 19%. So we're in the ballpark. I tend to think unless we see a recession, which again we'll touch on, we probably have seen the worst. Now usually returns post that decline tend to be pretty good. So I think we're in a choppy period, and it could, we could see that chop around for another few weeks or months until we get into the closer to the Labor Day time. So and then the last one I wanted to point out, because we do get a lot of questions on the geopolitical events and how does that affect markets. So this is something JP Morgan put together. It has a long list there on the left of different events, if you want to call them that, or geopolitical issues. First Gulf War, the 9/11 attacks, Iraq War, the Ukraine conflict the first time back in 2014. So as you can see, from 1973 to 2014, the average decline all the way to the right there is about 6.5%. If you count from peak to trough, and JP Morgan viewed February 11th as the kind of beginning of the event or issue or war in the Ukraine, the decline was about 8%. So we were kind of in the ballpark. I think maybe the worst is over on that one. Again, it's not a high conviction call at this point, but it does start to seem like things are lining up in that direction. So I'm going to pause it there. That's kind of the first quarter review. I know we have some questions, and I think we have a poll we're going to do as well.
So you'll see on the screen, which of the following do you consider our biggest risk in the health of our economy? We'll give you about 15 seconds to answer it and find out what everybody's thinking.
Yeah, and I think this actually came from a question we got from one of the clients, if I'm not mistaken. So we do read the questions, and we try to incorporate them as we go through. You want to any other questions out there while we wait for the poll results?
John, I haven't received any at this point. So
okay, all right. So quickly, since I can't see the poll, can you read off the
so the
options?
Yes, the The biggest risk that our audience sees is large government deficit spending, followed by inflation, followed by energy dependence, and finally rising interest rates.
Okay. Yeah, I mean, all those I think are big threats to the economy. I don't know if I'd put them in any different order. I think inflation, at least in the near term, is probably the biggest one, and I think Fed policy on how they approach that. And if you listen to some of the comments from Chairman Powell and then Vice Chair Brainerd, who they tend to be in sync with each other, have been more and more indicating they think they're going to raise rates 50 basis points in the May meeting. So I think they are starting to put out a timeline or a framework on how they're going to deal with inflation going forward. But okay, great, it's good to hear. So I'm going to keep moving. Again, I mentioned first quarter got off to a pretty slow start. I think really what was one of the things from the economy standpoint is we were dealing with the Omicron variant at the end of the year over the holidays, Christmas, New Year's. That kind of drifted into the first quarter, so we started off pretty slow. It seemed like we're finished the quarter at the end of March better than we started. So this is the Atlanta Fed GDP estimates, and I tend to use it. It's one of the better ones out there. And they're estimating about 1%, maybe a little over 1% as far as GDP growth in the first quarter. We think we closed a quarter better, so that could be a little higher than that. But the range is anywhere from from flat to 2% for the first quarter from the blue chip consensus. So 1% is kind of splitting the difference, and I think that's about as good an estimate as any. But I think we get that in about a week. So something we're keeping a close eye on. I always like to say I still think we're going to grow above trend. And I recently had someone ask me, what does that mean exactly? So this is a chart from JP Morgan. If you go back really since the beginning of the 2000s, the last 21 years, the trend line has been about 2%. Now we were growing above trend for a while there. We dipped below it back in the great financial crisis in 08-09, and then we've been kind of edging our way back up, and we were actually starting to grow on a long term. We got back above trend, and then we had the shutdown in March of 2020, and we're bouncing back. But we still think we're going to grow above trend this year. Obviously, we're getting off to a slow start in the first quarter, but we think the last 3 quarters of the year will be much more positive. Probably somewhere between 2.5 and 3.5 GDP growth for the year. A lot can happen. We got Fed policy, we got inflation, so that number can be volatile as we go through. But we think somewhere between 2.5 and 3.5. If you have to split the difference, I would say about 3% GDP growth this year. I guess the bigger important issue there, and I think this goes back to some of the questions we got, is we don't think we'll see recession in 2022. I think that's unlikely at this point. Again, the data can change on that, but where we're at today and the data that's coming in, it seems to be getting a little better, not worse. We think a recession this year is unlikely, probably below 1 and 4 or 25%. Now, as we get into 2023, that becomes a little different, and it's a little harder to forecast that far out. But as of today, I don't think we're going to see one, but that's a little tougher to make a prediction on. But again, I think the economy is bouncing back. This is the ISI survey. Company surveys, we follow this pretty closely because it's a great real-time indicator. I've used this many times, probably every time on the last 7 calls, to be honest with you, but I like to be consistent, and I think it's one of the better indicators. And as you can see, we had a little bit of a drawback at the beginning of the year. That's kind of the Omicron variant right there. And then we've kind of bounced back, and we're kind of holding that trend. And anything above 50 on this survey, and we're currently at 58, tends to be better than trend growth, which kind of goes back to my original comments. So we think we're going to see above trend growth. There's another reason why, and the data kind of supports that going forward. Unemployment, or the job picture, again, looks pretty good. 2 weeks ago, we had the lowest unemployment claims since 1968. And again, there's something called a participation rate out there, and that also is starting to go back up, which means more people are joining the work, coming back into the workforce that maybe either retired or just decided to not look for a job during Omicron or I'm sorry, COVID. So we're seeing that pick up again. One of the questions we had, does unemployment or low unemployment lead to inflation? And I think the answer is yes. It leads to wage growth, and I have a slide in there that we'll talk about in a few seconds, a few minutes, I should say. And then a couple more points on the market, and I'll move a little faster. Housing prices are still on fire. They're driving consumer net worth higher. Consumer net worth tends to lead GDP, so the positive cycle or loop continues. Higher prices on houses and/or markets tend to lead to higher consumer net worth, which tend to lead to more demand and consumption going forward. So I think that positive feedback loop is still working in our favor. And the housing's a interesting thing. I think it's more demographic than anything else, just because of the baby boomers. And I know of at least a couple of people, both in my personal life and here at work, who've sold houses and downsized to kind of take advantage of the markets out there. So I think we're seeing that happen as well. There's one thing that could kind of derail some of the movement in housing is the mortgage, and we've seen mortgages spike above 5% here recently. I think that's the highest we've seen in a while. It kind of breaks a 40-year long trend line. If you follow that red line there, that's the long-term trend. I know I've heard stories of people getting mortgages at 17, 15% back in the 80s. Luckily, I never had to do that. But we're back above 5%, and we'll see which way they go. But my guess is they're gonna probably hold above that red line for a while. And then wages are rising and unemployment is falling. So unemployment rate is now at 3.6%. Again, one of the things we mentioned at the beginning of the year, we thought unemployment would get it below 4% with a 3 handle. And that's already happened, probably quicker than we thought this year, but it's already happened. And then wages are going up. So the question we had about is a low unemployment inflationary? The answer is yes. And I think how that becomes inflationary is because as you get more and more demand, I think anybody that's walked into a restaurant or any place really in the last probably 6 months or a year has seen a help wanted sign, or my favorite is the we're understaffed, please be patient with us sign. And that tends to drive wages up, and when wages go up, demand goes up, and a component of inflation is wages, and we're seeing that right now. So again, participation rates starting to get better, so maybe that'll take off some of the pressure there, but I think the help wanted signs are going to be here for a while. And then as far as inflation goes, maybe if there's one sign out there, we're seeing some peak in gasoline prices, which I touched on earlier. The gasoline futures have been coming down, and we're starting to see that roll over on the AAA gas. Now, this is back in April 18th. That's $4.10. That's the national average. I know some states are lower than others. Here in Ohio, it's below 4, probably in the 370s, 380s. But I think we'll continue to see a little bit more of a relief on the gas pump. And then the other question we get a lot of recently is the yield curve. And in our view, the yield curve is still positive. We look at the 3-month versus a 10-year, not the 2-year versus a 10-year. And some of that's just academics. But if you look at the 3-month, which is the low end or the short end of the curve versus the 10-year, we're about almost 200 basis points differential. That's a positive spread, as they would call it. And that tends to be, pretty positive for economic growth. It's when it inverts, you start to worry about that. But even when it inverts, you got about a year or more before recession tends to take hold. My guess is we have at least a year before this yield curve inverts. So we have a little bit of a timeline, which is why we don't think we'll see a recession this year. And I think as of today, it's probably unlikely we'll see one next year, at least in the first half of next year. All right, so I'm going to take a drink of water, and I'm going to pause there, Emily.
So John, I do have a question related to the Fed and interest rates, and
okay.
whether if they raise too slowly in fear of adversely affecting the economy, is that really combating inflation?
Yeah, so I guess that that's kind of the big question out there. The market's trying to figure out is the Fed behind the curve, meaning they're going too slow, or are they right in line? And if you look at their comments recently, they have decided that, or they have kind of hinted or kind of led the discussion that they're likely to raise interest rates 50 basis points in the May meeting, could even be 50 basis points the following meeting. So I don't know if they're going slower for the markets. There's an old thing about the Fed put. I think that's kind of behind us. I was at a conference last week, first conference I've been to in over 2 years, and the head of fixed income for Vanguard, which manages a lot of fixed income assets and bonds out there. They manage some of the mutual funds that we use. Was asked a question if the Fed had to make the choice: is it beating inflation or avoiding a recession? And her comments were, and she was pretty matter of fact and pretty quick to answer, that she thought that they are going to try to lower inflation or get it back to an acceptable rate. And if that has a negative effect on the economy, so be it. She tended to thought that some of the work was already done for them because rates have moved so much higher. So maybe it won't be as adverse as people think. But I don't think the Fed, at least going forward, will let inflation run hot to benefit the markets. That's my guess, and that's kind of how some of the people in the industry view it as well. And I think that's how the market's starting to view it.
Okay, that's all the questions. Do we have a poll?
I think we do, yeah.
Yeah. So this is for our audience. What is the next 10% move in the S&P index? Is it going to be higher or lower? A few minutes to type in your answers.
So not to switch a subject, but I drove into work on Tuesday and we had snow. And I was in a whiteout, and it's the first time I got into traffic in 2 years where I was actually bumper to bumper. So I don't know. I mean, I've been in Cleveland 26 years, but I think that might be one of the latest snows we've had. We may have had one in literally like the first 2 days of May with anything of substance. But I had to get out and brush my car off that morning. It was would be the 19th of April. So
right.
I made the statement. Someone asked me about the weather in Cleveland, and I said, well, I've come to the conclusion that we have a late winter and an early summer. There's really no spring.
So it's close to half and half, but most of the audience thinks that the next 10% move will be higher.
Higher. Okay. I tend to agree with them. I was hoping that they would say lower because I tend to be a contrarian, and I'd rather most people be taking the opposite view of me. And I'll talk about that a little bit with sentiment in the markets. But yeah, 50-50. I mean, which basically means everybody's torn, right? No one. It's hard to figure out the direction of things. Long term seems to be like by the end of the week. But anyway, okay, great. So unless there's any questions, I'm gonna keep moving on.
You can keep moving on.
Okay, great. So multiples, one of the things we've seen move a lot in the last call it 12 months is the price to earnings ratio. We kind of thought at the beginning of the year we'd see it get under 20. It held above 20 for a while. We had a correction pullback in February, got down, I think, a little under 19, called 18 and a half, give or take. But we're now back above that. So we're still under 20 at 19 times. I think a lot of that's going to be directed on inflation. If the Fed seems to be having success lowering inflation, I think the multiples will kind of stay in that 18 to 20 range. If they don't, and we start to see more and more evidence that inflation is going to stay higher for longer, you're going to see a little bit of a maybe move lower. We're still looking at that 18 to 20 times range. I think that's where we're going to end the year, probably more likely in the 19 times earnings. Just to kind of put it in perspective, if 2023 earnings are on the S&P called 260, that puts us somewhere in the 47 to 5,200 range on the S&P, which is a little higher than we are today. So I still think we can see a little bit of a move higher here. But I do think earnings is going to be the key going forward. And I've kind of emphasized that for a while. We had a lot of returns earlier on 2019, 2018 on multiple expansions. I think we're going to see return driven by earnings. So again, we're in earnings season right now. We're just probably really in the second week of it. So we're probably less than halfway through earnings results, but a couple of the bigger banks came through, and we'll get the tech names in a week from now, the Apples and the Microsofts. But earnings should be pretty strong in 2022. This is from Credit Suisse. They're expecting about an 8%. We started the year off somewhere in the 8 to 10 range. There's always some revisions going on. First quarter, we saw some revisions. We're starting to get into the really big, difficult comps because last year we had a big bounce off the shutdown. But overall, about 8%, or actually about 9%. I would guess that's probably going to fade closer to 8. And my guess is this fourth quarter won't be as high as 13. Might be closer to the 10% range. But either way, markets I think follow the direction of earnings, not so much the percentage of growth. And I think we're going to see positive returns again in 2022. It seems to be the case in 2023 as well. But again, it's a little further out. It's a little hard to forecast with all the movements in interest rates and policy. But just to reiterate this, I've probably used this before. I think I have. SP rallies despite hikes in the Fed funds rate. So we've seen one hike of 25 basis points. I mentioned earlier we're probably going to see a hike of 50 basis points in May, possibly and probably likely another one after that of 50 basis points, which we haven't done in 20 years, raise rates 50 basis points at a time. But that being said, the last 4 times the Fed raised rates, even though they raised rates, somewhere in that 300 range on average, and I don't know if we'll get to that or not, but my guess it will be somewhere between 200 and 300 basis point increases over this current cycle. The S&P tends to go up. It tends to be somewhat flat in the first couple of increases, and we're seeing that today. We've seen a pretty flat market. If you go back to December 1st of 2021, rates have gone up 150 basis points, basically doubled from 140, they went up 150 basis points. We're in the 290 range, and the S&P is only down about 1%. So we've kind of following the playbook so far. So the direction of rates going forward, direction of markets going forward, it's always a little hard to forecast these things, especially with all the gyrations going on. But JP Morgan put this chart together, and I think barring a recession, and that's kind of the key, I think the lows are probably in for the year. If you look at this column all the way to the left, the S&P, the average stock, so it's not the index, but the average of all stocks in the index, dropped about 20%. Other recessions are around 40-ish, a little over 40. If you're just in a large sell-off in the market, that tends to be somewhere around 25. So we're in that ballpark. But if you look at the Russell 1000, which is a little more broader, it's right in line. The Russell 2000 small caps are right in line. So barring a recession, I kind of think that we're probably pretty close to the bottom being in. And if not, I think, we could retest that. But I think the majority of the decline is probably behind us at this point. Doesn't mean we can't move sideways for a while. And that's kind of what we've been doing for the last, 2 months off the low. But a lot happened on that bottom in March. So we had 4 straight days of the S&P being up 1% or more. That's only the 5th time it's happened since World War II. And as you can see here, every time 6 and 12 months later, markets have been higher on average. Again, I won't say the market's going to go up 27.5% over the next 12 months, but it does tend to have a positive bias going forward. And I think that's really what we're looking at, the positive bias. I can show you 20 of those slides, but we had what they call a breath thrust event off that low in March 8th. And since then, we've been seeing pretty good sentiment readings, which tend to be counterintuitive. Again, best 20-day high reading in 11 months, we got to go that high water mark, which is 50. 50% of the stocks are above their 20-day moving average. It tends to be bullish and going forward. And again, that's coming off the low. Just to put that in context, a year later, the average return's about 15%. So again, I think, and I can show you more of these if you want to see them. You can email me and I'll send you a few other ones. But to us, it kind of says we may have put a bottom in at that point. So it's something we're keeping a close eye on. But I think it's, as we get more and more time here, it seems more and more likely. But again, geopolitical issues could always pop up, and that could cause another correction. But how do investors see the world? I know we asked a question about the economy. What's the biggest risk to equity markets? From the this is a poll from Evercore, and they poll about 150. I was actually one of the people in the poll, and the bars count are different time frames. So if you go back to the March, which is this kind of a lighter green color, the biggest issue is geopolitical risk. But as you go to April, the April poll, it's now inflation at a little over 20% and the Federal Reserve action about 25. So kind of going back to my comments earlier, the things we think drive the market wasn't the Fed policy, which is now one of the bigger concerns, inflation and geopolitical risk. And those are all kind of high on investors' minds as well. And then the other question we get a lot about, or we've been watching, is where do rates go? And this slide's a little old. I pulled it out from January. I used it, but the reason I did is Chigas went back and looked at ranges when you see these big rallies in bond yields, and they've listed several here. But if it was the QE era, just going back to 2008, it's the average is about 175 basis points, which would have put us around 225. We're already past that, as you can see. But if you go back to 1981 and look at all the rallies out there, they tend to rally about 245 basis points on average, and you can see the numbers on those those red arrows. If we would go back and do 245 basis points, that's about 295. I think we touched 290 earlier this week, so we're right in the ballpark. So we might see a little bit of a reprieve here in the coming weeks on rates. I mean, they move pretty quickly, pretty fast. So we're keeping an eye on that. But I think 3% or 3.25% is probably what we'll see over the next few months. We could get higher as we go through, but I think there's likely to be some consolidation in here. So I'm going to stop there and drink some more water. Any other questions out there?
John, this is a good question and possibly an opportunity to remind people how our philosophy in managing our portfolios. Why did we not anticipate a sell-off at the beginning of the pandemic and move to cash?
Yeah, so in hindsight, that's a great question, and it's something we could have easily done. We could have sold all equities on January 3rd, and bought them back on March 8th, and had no harm done. I guess a couple of things. One, we don't really market time, and I would consider that market timing. Trying to call the top and call the bottom. So it's not something we normally do. It's not part of our philosophy. So our philosophy is we tend to stay invested. We tend to have a diversified portfolio, not just in U.S. but international equities, as well as bonds, if that's an area of concern from a risk standpoint, and in cash as well. And I think the other thing is we try to keep costs low, and we try to rebalance portfolios. So we've had 3 years going back to 2019, 2020, and 2021, where the markets were up double digits. So we've been taking some profits along the way. We took some at the end of 2021. We've taken some at the beginning of this year, and try to rebalance to those long-term asset allocation targets. But I just don't see a lot of value in that market timing process. And there's an old saying, you got to get it right twice. You got to get out the right time, and you got to get back in. And I think that's a very hard thing to do. We still have some clients that wanted to get out in 2020 near the low and have not gotten back in because of their concerns. So I think that answers the question. I don't know if you have anything to add to that, Emily.
No, I think it makes sense. It's just, I think if we try to time it, we're gonna be more hurt than helped by that. And I
Yeah,
think the most important thing is picking the right asset allocation for any, given circumstance. So,
I agree. I agree. So, okay. If we don't have any other ones, I'll move on.
okay, no,
So, one of the big changes we've seen, we're beginning to shift away from that cyclical bias we've had. We're still overweight cyclicals, but to a lesser extent, as you can see, we're now overweight energy. We've made a slight move to healthcare. I think if you look down the road, we'll probably add to healthcare because I think we're in that late part of this cycle, which can go on for a few years, but tend to shift from a characteristic of what tends to lead. So we've increased our healthcare. Staples are still basically even at about 4 basis points, but something again we're looking at adding to as we go through. And we've actually, what was once our biggest overweight was discretionary. Now it's one of our bigger underweights. Again, only 56 basis points, but so we definitely have seen some shifting in the portfolio. Still have a lot of large cap names, the Apples, the Amazons. We think long-term secular view of those are still very positive. They've kind of come under fire here, and again, kind of going back to that timing question. We've taken some gains on those, but we've elected to kind of ride the storm out with them. And I think from a long-term secular view, they're going to do fine over that period. We are kind of at that moment of truth between value and growth. This green shaded area is where growth has outperformed. Again, the Amazons, the Googles, the Apples of the world. And we've kind of moved sideways here a little bit. We've had a period where value outperformed, growth kind of had a bounce back, but it looks like value is still reasserting itself from a leadership standpoint. So we're kind of keeping a close eye. If in fact this does break trend, and this is a Ned Davis research report, and they kind of call the growth bull market over, and it's a shift towards value, you'd probably see us, again, make some more larger changes within our portfolio to reflect that. International equities do look attractive. Again, we mentioned about keeping a diversified portfolio. We own developed markets as well as emerging markets. And if you look at the current ratio, the S&P, again, it's called 19.5, and the everything outside the U.S. in the ACWI, so that basically the world minus the U.S. is about 13 times. It's about a 32% discount, so to speak, on that. That's well below the average of 14. So you could argue that international equities are attractive, especially as you look at where they trade versus a 25-year average. The U.S. is a little bit above that. Well, not a little bit, is above that. Europe, Japan are below it, and China's below it. Emerging markets right about there. So you could argue that there are some international markets look attractive. I always say, you're waiting for the catalyst. I'm not sure what that catalyst is. It could be a change in the dollar's been strengthening. It could be a switch in the dollar. It could be, a change in Fed policy and higher rates. I know Japanese rates have gone up a little bit. German rates have gone up. So maybe it's a switch there. But so far we haven't really seen it. And we're currently in a position of dollar strength. The dollar's been strengthening all throughout the year, and history would tell you when the dollar is strengthening, the S&P, returns about 9.6% versus the developed markets of about, call it 1.5, and the emerging markets a little less than that at 9.3. So far it hasn't really seen a change. Although I think we're probably close to seeing a change there. I do think the U.S., much like growth, it's had a really long run here, so it's a good chance we'll see a change there. So I got a bunch of things that kind of, what we're looking at going forward, more midterm, middle of the year and second half of the year stuff. But before I get there, any questions out there, Emily?
well, first of all, I have to thank one of our clients for pointing out it's time in the market, not timing the market. So
right.
we love that phrase. One more question related
I'm kind of
to.
disappointed I didn't say it because you do, but anyway.
Yeah. One more question related to our portfolios. Are we doing any investments in defense related stocks?
Yeah, so we So the defense names, the aerospace and defense names tend to fall in that industrial sector, and we do have an overweight in industrials. We actually, in our individual large cap portfolios, have a weighting in General Dynamics, which is a defense contractor. They also make the Gulfstream jets for corporate use, commercial use, but they are a defense contractor. So we own them. We've actually looked to add to the position. We may add another one out there. But yeah, I think that's an area that's done pretty well. If I've heard the term that globalization is over, if that's true, and we are entering a new phase of, I don't want to say hostilities, but maybe of a Cold War type of thing, then they could benefit from that. I think it's a little early to make that statement, but from the amount of arms being shipped to Ukraine, you can kind of argue that maybe at the very least there's a replenishing process going on. So it's something we're keeping a close eye on, and it's something we do have exposure to. And if I had to make a prediction, I would say we'll probably be adding to that exposure, not reducing it as we go forward, especially as we watch the events unfold. Is that it?
I think that's it, John. You can keep moving forward.
Okay. All right. So I know we had a couple questions, and they were all kind of variations of the same one about is a recession likely or not likely. So I already kind of made our point. I think a recession in 2022 is unlikely, mainly for some of the economic data that we see right now. But the risk is rising for 2023. I wouldn't call it. It's not a 50-50 proposition at this point. But this is and these are the February numbers. The March numbers will come out here pretty soon, but they weren't available yet. So the Cleveland Federal Reserve and the New York Fed, these are regional banks, do their own recession probability studies out there. And so far, again, they may rise a little bit here in the March numbers, but the Cleveland Fed did about a 5% chance of a recession in the next 12 months. So again, in February, that's pretty much meaning 2022. And the New York Fed's about 6%. Again, I would guess as the March numbers come out, they might go up a little bit, but they're still under 10%. So I think it's more likely than not. We are going to be getting more and more. In fact, I think there's primaries here in Ohio and Pennsylvania in May, and they tend to be two states that have senators retiring, and I know there's a lot of money being spent on those races. So I think we're going to see this election cycle kind of pick up a little bit as we go into the next couple of weeks. And this is the Dow Jones Industrial, which is pretty similar to the S&P, but it goes back further, so there's more data to it, going back to 1900. This is kind of how the markets tend to move. And again, each year is a little different, but that second year of the presidential cycle, you tend to move sideways or slightly down, which is kind of what we've done so far, until you get around Labor Day and election days. And as I mentioned earlier, that 12 months after the midterms tend to be the best 12 months in this whole cycle. So you see a move from here, to here. I don't know if history repeats itself perfectly like that, but I do think that we can see some more consolidation and sideways movements as we get more clarity from the Fed, more data points on inflation, hopefully that it's going down. And then as we move into the midterms, these things could line up on themselves, and it'd be even better if we get some type of ceasefire out of Ukraine, although it doesn't seem likely in the near term. But voters are definitely starting to look at the midterms. I think this is not a political statement, but the president and the party in power, the Democrats, got some headwinds ahead of them. Most midterm elections tend to be a referendum on the president or the current administration, and voters are demanding action on inflation. So again, inflation has been front and center here. 68% put reducing inflation and the cost of living improvements as a high priority for the Biden administration. And I know the president's been out there jawboning about inflation, as has anybody running for re-election here in the last few weeks. So something we're keeping a close eye on. Gas prices will probably be one of those things talked about a lot. So if you look towards the midterms, how do you approve or disapprove of President Biden's handling of the job? November, it hasn't really changed too much, but in March he got about 42% approval rating. I think that's actually dropped below 40. And the reason that's important is because as you get closer to the midterm elections, if you have a approval rating somewhere between 40 and 45, you tend to lose about somewhere between 30 or more seats in the House. And I do think most people are predicting a switch in the House. The Senate's a little tougher to call. And if that's the case, then you're going to have divided government. And historically speaking, divided government's not been a bad environment for equity markets. So that's probably the most likely scenario today. But we have 7 months before the midterm, so a lot can change. So I wouldn't bet the farm on this yet. But once we get past the midterms, as I mentioned, returns tend to be pretty good. You see about 15% there. And I think, again, I'm not predicting 15%. I'm just predicting that tends to be a positive bias in the market going forward. So I think we get some choppiness here in the next couple weeks or months. But I think as we get closer and closer to some of the clarity on Fed inflation, and as we get closer to putting the midterms behind us, I think the markets will tend to act positively. So again, a lot of questions on inflation. How do you hedge your portfolio? Well, really, if you look at this, you have total returns of both stocks, gold, bonds, and cash on the left, and then returns after inflation. Equities, after inflation tend to return about almost 7%. So I think equities are a good place to put it. I do have some concerns on bonds. I think just the returns will be somewhat muted. I think bonds are still a great thing to help diversify, help stabilize your portfolio, especially in times like 2020 when you see a big decline in the markets. But I think the returns and the coupons, or the returns are going to be less in coupon and to be a little more muted going forward. Not to say you shouldn't have them in your portfolio, but maybe the expectations versus the last 30 or 40 years are going to be a little more muted going forward. And I think, as I mentioned, with the negative returns last year and most likely this year, we're going to see that going forward. But as we always say, we like to stay focused on the long term. And for those people that have a 10-year or more horizon, or even a 20-year horizon, returns tend to be pretty good for equities. I don't think that'll change over the next 10 years. I think that the ride could be a little bumpier than normal. And we've seen a lot of that over the last 2 years, or actually 3 years now, going back to 2018, 2019. But I still think, there's a positive bias going forward. So I'm going to open up the questions if there is any. Before I do that, as I normally like to do, I'd like to thank the marketing team for helping us put this together, specifically Annika. And I'd like to give a shout out to Jocelyn today. She's one of our newest employees, and she gave me some last minute fashion advice on if I should wear this jacket or not. So I appreciate that as well. So any questions out there, Emily?
No more questions, John, but I do have to thank you because I know that this wasn't an easy task given that you're under the weather today. So yeah. You did great. We just really appreciate everybody, your work in putting this together, the investment team. For those of you that have additional questions, feel free to reach out to the investment team directly or to your advisor. Check out our website for upcoming events later this year. And as always, we thank you for joining us today. It's a privilege to inspire you and your families, and we are so grateful for your trust and loyalty. Please take care of yourselves, and we look forward to seeing all of you in the near future.
Yeah, thank you very much. Thanks, Emily.